Okay, so good morning, everyone. Welcome to the Snapshot. We are Thursday, March the 27th, 2025. So obviously the big news is that yesterday, Donald Trump, in the late afternoon after the cash market closed, announced 25% tariffs, basically effective more or less immediately on car imports, and it's not into the US, and also sort of auto parts. But it's not exactly certain exactly which part of the supply chains are affected. But more or less, it seems that cars coming into the US and auto parts will be subject to 25% sort of a tariff immediately. And of course, we have additional tariffs on all kinds of things coming in on April the 2nd. So definitely, it looks as though tariffs are rolling in. However, it's important to keep in mind that the market reaction has been relatively muted, except for very specific sort of sectors, like we've seen Ford down, General Motors down. So the American car makers and obviously global car makers are taking a bit of a hit. But Trump also, during his sort of press conference yesterday in the Oval Office yesterday evening, or late afternoon, said that there would be sort of, a nice surprise coming on April the 2nd, and that he was going to be sort of friendly and nice and probably more lenient than everyone was expecting for April the 2nd. So that's why the market may be sort of balancing this a little bit. And who knows, we're going to get 25% on sort of car imports, but maybe the tariffs coming on April the 2nd will be, not 25%, but maybe more on the sort of, 6, 8, 10, 12% range, and much more sort of targeted and a piecemeal. So the market is taking a little crumb of comfort from that. But if we actually just sort of look and just look at it just in terms of the cars, it's kind of interesting just to see what's going on here. And keep in mind that 46%, so almost half of the new cars which are sold in the US are basically imported. And the main countries affected by this is Japan and Korea, who import or export a lot of cars into the US. And of course, a lot of those Japanese and Korean car makers actually have cars assembled in Mexico and Canada, which are then exported into the US, and then, of course, from the European Union. But it's just sort of interesting here to just have a quick look at a couple of charts here. Imports as share of US vehicle sales by automakers. So you can see that Volkswagen is going to be very heavily affected in a negative way by this. Hyundai, obviously, the Koreans, Mercedes over in Germany, Renault, Nissan, Mitsubishi, BMW, etc., etc. So you see that, obviously the US car makers, GM, and Ford are less exposed, but some pretty heavy sort of exposure for some of these global companies, Volkswagen, Hyundai, Mercedes. The other thing, which is just another couple of numbers here, is where most of these imports come from. And as you can see, in terms of the volume and just actually the dollar value, Mexico is really the one which is going to be hit. So interesting to keep an eye on the peso here. The Mexicans are reacting in a very sort of calm way, but this is definitely a significant sort of challenge. Japan, South Korea, Canada, Germany, as I said, sort of there are some of the numbers there. It's interesting. There's definitely sort of a sense of betrayal. I've just been reading some comments this morning. The Japanese, Prime Minister, who was in Washington with Trump about 3-4 weeks ago or so, promising, a huge amount of investment in the US, the Koreans, Mexicans, Canadians. Everyone believes that they've sort of stepped up to try and appease Trump in some way and offer sort of investments. So this is definitely going to be taken as a sort of a slap in the face by those trading partners. And also what was interesting is that sort of late at night, there's been quite a lot of talk recently of sort of Canada joining, countries like Canada, maybe Mexico, joining forces with the European Union to present a stronger, more united front to the US. But Trump, in his inimitable way, late night on a Truth Social posted that, if, for example, Canada and the European Union were to unite sort of together against US, he would, I forget the exact quote, but basically sort of retaliate in a nasty way, shall we say. So interesting times. Carney from Canada already sort of out defending Canada's interests. But let's just look at the market reaction here. And as we say, like, I was just looking, things like Ford and General Motors are down. But if you look at some of the countries most affected, so let's say, for example, look at the USD CAD. Because Canada potentially could be very effective. Down a little bit. I mean, this is a daily chart, but even on like a 3-minute chart or something, you can see here, just putting the tariffs here, not much reaction at all. So initially, US dollar up, Canadian dollar sort of down. If we look at something like the euro, we see that the euro is actually up against the US dollar. So what's kind of interesting, and again, if we just let's look at a couple of the stock markets here. So let's look at the euro stocks. So there's the euro stocks, which was down, but has subsequently sort of sort of clawed its way up a little bit. So we're not talking some sort of massive red candle here. And also, if you look at, let's say, the Germany index, a gap down a little bit, but is sort of hanging in there. So was this sort of partly expected? Yes. But what's interesting is if we then sort of shift our attention over to the US stock market, let's say the ES, you can see that that's not exactly sort of ripping higher. And if anything, sort of gap down and is just sort of crawling, pretty stable here. So it seems as though that the market could, and again, I emphasize the word could because it's early days, could be interpreting this as through the lens of sort of a hit to economic growth, let's say in the US and more generally sort of in a global sense of trade. And if you look at the dollar index, which we know is 58% euro, so it's not completely representative of every single sort of exchange rate. But it's interesting that the dollar's first reaction, the consensus, if 2 or 3 months ago when Trump started talking about tariffs was, oh, it's got to be sort of dollar positive, but actually dollar negative on the immediate headlines. And it seems just looking at the market reaction over the last sort of 6 or 8 hours that the market is taking this as sort of as a growth slowdown. The idea that these tariffs will make cars certainly more expensive, at least in the short and medium term. It's going to be more expensive for American consumers, et cetera, et cetera. So kind of a negative thing for growth, potentially job losses globally, pressure on, various other sort of global economies, Mexico, Canada, parts of the European Union, Korea and Japan and whatnot. So basically a hit to global growth. Now, Trump himself, in the Oval Office yesterday said that medium term, essentially what he's trying to do, which maybe it's going to be too long-term or simplistic, is to force car manufacturers not to assemble cars in, let's say, Mexico or Canada or import directly from Korea or Japan, but to actually start building sort of plants in the US. Because the idea is that in the US, as far as I can see, the big three US automakers, they do have some spare production capacity, so they could ramp up production a little bit. But, people like, I don't know, Honda or Hyundai or Mercedes-Benz, it seems from what I'm sort of looking at that they don't have a spare capacity. And so you're talking about a complete build out of new production capacity, which is obviously a multi-year kind of time frame. So, potentially could this provide more jobs, industrial jobs in the US? Yes. Infrastructure jobs? Yes. More cars produced in the US? Yes. But this does, to me, seem to be a sort of a multi-year kind of project, which may or may not be, feasible or positive. Probably will be positive in the, for America over the medium term. But just at the moment, the market is taking this as a hit to American and global growth. And you see that reflected here in the dollar index. Also kind of interesting to look at something like oil. Where's oil? If we look at oil, and again, oil here, not that collapsing or anything, but just, certainly not sort of skyrocketing on this. So just interesting just to look at that overall. And in terms of like the US, again, this gets us to a sort of a bunch of other sort of interesting things that, a lot of the consensus recently has been, that there will indeed be sort of a global sort of hit to growth, and the US economy is going to sort of suffer because of, things like this imposition of the 25% tariff on cars. We shall see. I mean, that seems potentially plausible, realistic, and perhaps even logical. But the reality remains that the gap, there is a huge gap between soft data and surveys and the hard data. And the reality is that the hard data, there have been some signs potentially of weakening, but the hard data is still pretty robust. And today we have, just look at a couple of things. We have sort of initial jobless claims, which I'll just put up here. And we see we have initial jobless claims, which is relatively timely because it is a weekly number. So we have initial jobless claims here. Where are we? Oh, yeah. 225,000, which shows a very, very robust US labor market. So this continues to be the state of the US labor market. Still seems to be very, very strong. We're not talking 3 or 4 or 500,000 initial jobless claims. We're talking 210, 215, 220. So that's still pretty strong. We're going to get a sort of an update here on the GDP, but again, this is a third reading of fourth quarter, so that's getting a little bit sort of old. If we look at a bit of data, just to sort of keep on this theme of how is the US economy actually doing, I just want to go to just look at a couple of data points from yesterday, again, on the very excellent Daily Shot website, which has, a data overview every day. So we look at durable goods yesterday. And again, durable goods is a choppy number. It's a complex number. We can't sort of draw too many conclusions from it. But the reality is, for example, if we look at the overall number excluding transportation, what you see is that the survey or the consensus was 0.2, but the actual came in at 0.7, so higher than expected. If we look at motor vehicles, that was higher than expected. Of course, that might change now that Mr. Trump has put on sort of tariffs, we shall see. Then you look at things like computer and electronic products. That seems to be higher than expected. So you get the point that a lot of the various metrics here in non-defense, excluding aircraft and parts, pretty good. There were some weaker numbers. So capital goods orders, non-defense, so there were some slowdowns here. But as you see, it's not consistently weak or poor. There are some evidence of slowdowns, and definitely prices paid does seem to be going up. You see, for example, the Philly index was down a little bit, like prices paid up a little bit. So the point is that there does seem to be a general sense that the real economy is I would say reasonably robust without being, hugely expansionary, but with some pockets of potential slowing or weakness, but with sort of strong prices. So I think stagflation is a very strong word. I would say some kind of sort of stabilization in the US economy. And then that's the point. Until and unless we see actual hard data, a weakening consistently and significantly, it's difficult to be, I would say, incredibly bearish on stocks or sort of positive on bonds. There's going to be sort of squiggles, but I just think there's a lot of projection going on. That's it. What is kind of interesting, though, if we look at the Atlanta Fed. Now, we know the Atlanta Fed, they pride themselves on having a sort of a real-time nowcast to give a pretty quick, here we are, here the what do they call it? The real GDP estimate. And they kind of made a big mistake because there was a lot of gold imported. And they said, oh, we actually made a bit of a mistake here. But they have readjusted that, accounting for the gold imports. And we'll get onto gold in a second. And you see here that the Atlanta Fed GDP Now estimate has been revised. And that is negative. So you see what I'm trying to say? That there are some sort of indicators which are negative. Others are sort of positive: durable goods, initial jobless claims, the labor market. So it's a complex, choppy kind of moment. So let's keep an eye on that. Something else in favor of the bears, to be honest, is that the airline, there was some airline sort of travel sort of numbers coming out yesterday. And you see here, this is the number of airline passengers transiting through basically the airport checkpoint. So it's a kind of a proxy for airline passengers. And yeah, that definitely does seem to be sort of going towards the downside. On the other hand, we see that, for example, cruise ships are doing very well, like Carnival. The bookings are up and everything. So the whole leisure travel thing, it does seem to be down in terms of some hotel bookings and sort of airline sort of flights. But on the other hand, we have other parts of the leisure travel sector which are doing quite well. So again, a bit of a mixed picture there. What I would say, just getting onto gold. And you sort of say, well, okay, just why are we getting these massive sort of gold shipments into the US? And you see here, sort of like just how much of that has spiked. And that's also, if we go to just want to go to the commodities section, is because as we know, the traders were trying to sort of front run the potential tariffs on metals. And we talked yesterday a little bit about sort of the potential tariffs on gold, on maybe silver and on copper, and that's causing huge amounts of those physical quantities of copper, gold, and silver to be pouring into the U.S. Exchange sort of warehouses, just to sort of front run that. And there's almost essentially kind of like an arbitrage kind of trade happening at the moment. So if we see here, just looking at the commodities section here. You've got here, for example, coming out of Goldman Sachs, we saw a gold up very strongly this morning, up another $35 or so. Just kind of interesting here, where Goldman Sachs sees gold, at the end of 2025, they see it up to $3,300 here. And again, you see the realized is the blue. There's their forecast in the brown. High uncertainty positioning, okay. But what is kind of interesting is how they see where the price coming from. And they see that if you look in the brown here, it's kind of like a cumulative price change. But they do see that financial and monetary authorities, which is essentially a proxy for foreign central bank buying of gold bullion, which is the blue, which is still a very strong sort of push. We also get some sort of input from investors like the GLD ETF and just your basic speculators on the futures, which is relatively soft here. So it's interesting. You're seeing like some inflows into the ETF, and definitely central banks is still seems to be like sort of quite a big deal in terms of the gold. And probably geopolitics and the uncertainty of Trump's policy is probably is probably helping that. Just while we're here on the commodities, starting to look a little more like things like the grains. You see that the grains are under pressure. You see corn making some new local lows here. So we see the corn down. We also see the wheat futures heading to sort of local lows. So definitely the grains sort of under a little bit of pressure just at the moment. And part of that, I mean, I again, don't want to get into details, but part of that is that there is still a little bit of uncertainty about sort of a peace plan in Ukraine, especially around the Black Sea area, which is obviously one of the export hubs. And there's just a little bit still of uncertainty as to whether there will, in fact, be a durable ceasefire in the Black Sea. And therefore, that's putting maybe a little bit of sort of uncertainty into that market. Although having said that, you see that the wheat is trading at a low area. So how important that is, of course, is to be seen. So just getting back to a couple of other things, I just want to get back to a couple of charts here, guys. Again, just talking about the metals. If we go, actually, sorry, let's go back here. Let's just talking about gold. Let's just actually have a look at that gold chart. And again, just getting onto oil here. You see that oil, I was reading something yesterday, actually, I think I've got the chart on, just in terms of the base price for WTI. What is interesting, there was a survey which the Dallas Fed does, because, the Dallas, obviously, in the middle of sort of oil country here. So just to sort of keep this simple here, this is basically the different sectors in the US where oil is produced. So you see here the Permian, the Eagle Ford, this is parts of Texas. And essentially here, the bottom line here is what's your break-even point for profit drilling oil in especially in the Texas area. And you can see here that it's anywhere between about $61 to $70. So kind of like the mid 60s is the break-even point. And it is interesting keeping that in mind if you then just start looking at a chart and you see the WTI here, that indeed, if you go back quite a long way, you can see that that's sort of, mid 60s price here. You see here about $66, $67 is sort of where the market has found a bottom over the last, I mean, basically sort of year and a half, 2 years here. So it does seem to that break-even price of around about $63, $64, $65. The market is happy to trade in that range, but doesn't particularly want to go lower than that. So that's interesting. So the question is, if Trump administration, they want crude oil to go significantly lower, that's going to be a problem because those American oil producers do not make a profit if the price of WTI is below, let's say $62, $63, $64, depending on where it is. But basically, let's say early to low 60s. Anything below this level here, they don't make a profit, and they would actually stop, or not stop drilling, but reduce the amount of oil, which of course would put upward pressure on the price. So it's interesting to see how the Trump administration wants to sort of drill, baby, drill, and get the price of energy down, or oil, because it's going to be difficult, in my humble opinion, to get this below, let's call it around about the $65 barrel. Just still on the commodities, we just looking at the gold here. You see the gold has made a nice big run up. I mean, it's pretty incredible. Just a very, very shallow retracement down to about $3,000. I guess there was like a psychological level. Looks like buyers have come in again. Lingering inflation, concerns about global growth. Will this lead to sort of, the Fed maybe cutting earlier than expected? Who knows? And of course, just geopolitical and sort of policy uncertainty. It's all good reasons, apart from central bank buying, to continue buying the dip in gold. What is interesting, I was talking, I think, yesterday about the silver gold or the gold silver ratio, and we see that once it got to the top here about 92, generally that's a sign for silver also to, on a relative basis, to do pretty well, even to outperform gold as it gets back down to the bottom of the range. And if we actually look at silver, let's look on the futures here. You see silver since it hit that sort of 92 level on the gold silver ratio, is actually sort of popping much higher and looks as though it wants to retest what is turning into some kind of a triple top here. So silver's starting to break out. And as you know, a lot of these metals, the precious and the semi-precious move together. Copper just having a bit of a pause in, and copper is an interesting one because at this point, again, trying to front run these potential tariffs on copper imports into the US, as I was explaining yesterday, scrap metal is not leaving the US. It's remaining in the US, and that's putting sort of upward pressure on global prices for copper everywhere. But I just wonder if we're running out of a little bit of steam here, because if you look at this sort of Fibonacci extension here, it would argue for a little bit of a pause up into this sort of red box that's getting to the top of that, which also, of course, coincides with sort of the high going back to May of 2024 at about $5.2 per pound here. And just having a little bit of a pause here, kind of spiked above. And at this point, it's just interesting that between the London Metals Exchange, which is the other big principal market, and New York, which is what we're watching here, this is the HG, the high grade contract, there's a 17% sort of premium, so like an arbitrage trade. And that's why all of this metal has been sort of literally put on planes to try and get it into the US, the same with gold. And we see the inventories at all of these metal exchanges in New York are really being sort of filled with gold and copper and silver, just trying to front run potential Trump tariffs. But I just wonder at this point, 17%, they're running out of time to avoid the tariffs, and this has come a long way. So interesting to see here if this is now combined with sort of a bit of a scare about global growth. Could copper, just take a little bit of a pause here? That's going to be kind of an interesting one, just to note if this sort of tariff window is actually closing. Okay, so just finally, going on a bit too much here, I'm going to sort of wrap this up here, guys. We see that VIX just sort of going up a little bit. It sort of crawled off the lows of about $17.5, or 17 to 17.5 points. It's now at about 18.5. So VIX going up a little bit. Interesting. I pointed out yesterday that if you look at the front contract of ES, so go to the ES June, which is the front or prompt contract here, you can see that on the futures, that actually, the resistance of the 200-day EMA, exponential moving average, it was rejected there, and we're now sort of going down. Again, not a huge amount of price action overnight and not any dramatic reaction to the Trump auto tariffs, but interesting to see where the market really just sort of say, whoa, this thing is really going to create a big drag on US and global growth, and it's going to be reflected potentially in the US stocks and also in the European stocks. So let's keep an eye on that. In terms of the bonds also not loving the potential for increased inflation. So if we look at something like the 10-year, the ZN here, you see on terms of the price going down, the yields going up, of course. And if again we look at the ZB, which is the proxy for the long end, you can see that's come off quite heavily. And then you compare that to the 2-year, which hasn't come off a lot. So definitely what we're getting here is a long end led sort of bear steepener. And if we look at, let's say, the 2s to 30s curve, which is here, you see that's steepening quite a lot, and that seems like it's going out into who knows where that's going to end up, probably potentially up to maybe 81 basis points or so. And again, this is just concerns. So we have sort of two sort of forces here. Is this idea of, potentially global growth will be slowing down, which of course normally would be a negative for yield. So price going up and yields going down, and potentially could even be some kind of flattener. But it seems as though the market is interpreting a lot of this Trump tariff announcement and news as the real economy is doing okay. As we were saying, the real economy actually is not really dramatically slowing, but we do have the potential with the tariffs of extra inflationary pressures, which means the Fed, maybe the Fed's not going to do too much. It doesn't look as though the Fed will hike to actually stamp down on inflation. So we have a Fed which is most probably going to be doing nothing. And actually, if anything, the risk would be that the Fed will cut if the labor market and the real economy slows down. And so that therefore leaves sort of inflation festering at this sort of sticky level. And the bond market, especially the long-term bond market, the long end of the bond market is not liking that. And so pricing in a steeper curve and a lower price, of course. and higher nominal yields. And then also, at a certain point, gold, just getting back to gold here, is also an inflation hedge. So that also gives a little bit of an extra boost for gold. Okay, guys, so I'm going to wrap it up there. Let's keep an eye on initial jobless claims. Any more comments out of the White House? Interesting, too, is going to be to see if there's any more specific retaliatory sort of tariff action taken by countries like Mexico, Canada, the European Union, Korea, Japan. I think they're probably all huddling. I know that Mark Carney, the Canadian Prime Minister, has called a sort of a meeting today, and potentially retaliatory sort of tariffs. So that is what we're looking at today. Also interesting to keep an eye on some of the current currencies, especially let's say the Mexican peso. Let's see how the Mexican peso's going again against the yen. Not a huge reaction. And if we look at the peso futures, again, not a huge reaction here. So. The point is that a lot of this has it all already been priced in, a lot of this sort of tariff stuff. Interesting. Okay, I'll leave it there. Have a great day, and we will continue the conversation later this week, no doubt. Thank you.